Hello, and welcome to the next in our series of Insights into IFRS 17. I'm Gail Tucke, PwC's Global Accounting Technical Partner responsible for insurance. I'm a member of EFRAG's Insurance Accounting Working Group and the ISB's Transition Resource Group. I'm delighted to be joined today by Susan Dreksler, who's a director in our UK actuarial practice. Welcome, Susan.
Thank you, Gail.
So what we'd like to do on today's video is actually look at some of the issues that are facing property and casualty or general insurers as they're known in some parts of the world. These insurers largely write contracts that are less than a year and so are likely to be eligible for the ISB's simplified premium allocation approach. One of the things they are going to have to do is discount claims if they take longer than a year to settle. We're not going to have time in this video to go through all the detailed intricacies of the PAA or premium allocation approach. I'd encourage you to look at the ISB's website where they've done 2 webinars on this topic, so please take a look at them if you haven't already done so, and they'll cover things like unit of account and onerous contracts. So Susan, one of the things I hear when I go around and talk to insurers is that PAA looks sort of a lot like the unearned premium we're used to today. So are there issues that general insurers should be thinking about today?
There certainly are issues they should be thinking about. What we're seeing at the moment is a lot of insurers who've opted to take the premium allocation approach as their default model are having to look to see whether their contracts are indeed all eligible for the premium allocation approach. Anything that's got a coverage period of over 1 year is not automatically eligible. In that case, the guidance says that the company has to reasonably expect that the liability for remaining coverage under the premium allocation approach will not differ materially from that under the building block or the general model. So insurers are having to look at those contracts, build models to project that liability for remaining coverage under the 2 bases, and then compare them and decide whether they are materially different. Unfortunately, the guidance doesn't give you very much to determine what does materially different actually mean.
And I think equally it doesn't give much guidance on what does reasonably expect mean. So I think there's going to be clearly an element of judgment in there. And when we talk about reasonably expect, I think insurers will need to look at scenarios that are reasonable and could happen, and then compare, as you said, the liability for managed coverage under the general model and the premium allocation approach. Now, if that's what we need to do, have we done some thinking about what could cause insurers to fail that eligibility test?
Yes, Gail, one of the issues that is likely to affect the eligibility is discounting. And the impact that discounting will have will depend on the term of the runoff of the liabilities and the term of the contract, of course. The reason being that you're projecting much further into the future, and the further we go, the more the impact the discount rate has. That's under the general model, of course. Under the premium allocation approach model, we're just looking at premiums. So that's why the discount rate may generate a significant difference. The other thing you need to think about with discount rates is not just the term of the contract and the term of the liabilities, but also the level of discount rate. So where you've got countries where discount rates are currently very low, even with a longer tail contract, frankly, is discounting likely to change very much? Not really. But in countries where discount rates are more significant and movements may be more significant, you may find that a contract eligible in one territory is not eligible in another.
Thanks. And the other thing we look at, if we think about the general model, they've got to look at the contractual service margin. Presumably that can have an effect on the comparison as well.
It does have an effect. One of the things is that the contractual service margin, the discount rate for that contractual service margin is fixed, which is one of the reasons that discounting has the impact that it does, because it only impacts the best estimate liability part of your general model and not the entirety of the liability for remaining coverage. And it doesn't affect the premium allocation approach at all. The other issue around the contractual service margin is you need to think about how it's amortised over time, and how the liability for remaining coverage will be amortised under the premium allocation approach. So for the contractual service margin, it's amortised in line with what they call coverage units. For the premium allocation approach, it's amortised using a straight line approach unless the release of risk is significantly different. So there's potential difference there. The other thing that comes in as well is a consideration around risk adjustment, because you have an explicit risk adjustment in your general model, your premium allocation approach model just has premium. So it's got an implicit allowance for risk, but not that explicit allowance. So if your risk adjustment moves significantly between accounting periods, that may also cause you to fail.
Thanks, Susan. I'm glad you mentioned the risk adjustment there, because today many general insurers don't have an explicit risk adjustment. They tend to have a margin they put on top of the actuarially calculated number. IFRS 17 clearly is going to require an explicit risk adjustment to be calculated. And the other thing to remember as well is that they will need to disclose the confidence interval. So for insurers who may use an alternative approach, such as the cost of capital approach, that'll be another thing they need to think about as well. They'll also need to think about the level of calculation of that risk adjustment, because IFRS 17 is not prescriptive in this regard. The other thing I just wanted to touch on is business acquisitions, because I think they may be something insurers need to think about.
Yes, they are. Under the new guidance, the way that you treat a business transfer or combination is very similar to a reinsurance contract. So, for example, if you've got a contract that was 1 year or less and therefore eligible for a premium allocation when it was written, when it's sold or transferred to another insurer, that contract becomes essentially a new contract. Even though it might have been eligible at one time, does not mean it will still be eligible. The amount, the transfer value, the amount that's paid over will be a proxy for the premium under this hypothetical contract. And the term of the contract will be the term that the liabilities run off. So the fact that the contract was 1 year or less and it originally is irrelevant, it's actually the term of the liabilities. So if you acquire a book of business that has liabilities that are going to take more than 1 year to run off, they won't be automatically eligible for the premium allocation approach. And so an insurer that uses the premium allocation approach as their default model will need to think about how they're going to either demonstrate PAA eligibility for that book, or they'll have to use the general model.
So that's certainly something for groups that have done a lot of acquisitions to think about. Thank you. So we've talked today about the eligibility for the premium allocation approach and also to think about business combinations. And that's really helpful. I think one of the other things that insurers may want to think about is the impact of IFRS 17 on reinsurance. Now, we haven't had time to cover that today. Again, the ISB has done a webinar on reinsurance on their website, so I'd encourage you to look at that. And I'm sure we'll have a future video where we'll be looking at some of the things to think about there. Thank you for watching.